Ladies and gentlemen, I welcome you all to the H2 and FY25 post-earnings conference call of JB Laminations Limited. Today on the call from the management team, we have with us Mr. Mudit Agarwal, Managing Director, Mr. Subhash Raghav, Chief Financial Officer, Ms. Aarti Chauhan, Company Secretary, and Mr. Ashutosh Singh, Deputy General Manager, Finance. As a disclaimer, I would like to inform all of you that this call may contain forward-looking statements which may involve risk and uncertainties. Also, a reminder that this call is being recorded. I would now request the management to detail us about the business and performance highlights for the half year ended 31st March 2025, the growth plan and vision for the coming year, post which we will open the floor for Q&A. Over to the management team.
Good morning, everyone. Thank you all for joining this call today. We're just going to run through the presentation that we created for you, and then we can open up the floor for Q&A. Vinay, could you open the presentation, please? I'm the Managing Director of JB Laminations Limited. We are a 36-year-old company with the production of CRGO silicon cores for power and distribution transformers. Currently, we have an installed capacity of about 18,000 tons in 2 units of production based in Noida and Greater Noida. Our products include cut laminations, slit coils, and assembled cores. We are approved by PTCL for. Slide, please.
There's a problem with your voice. Hello, Mudit. Go ahead, Mudit.
Yeah, so I'll just explain this slide again. Good morning, everyone. My name is Mudit Agarwal. I'm the Managing Director of JB Laminations Limited. I present to you the performance highlights of H2 FY25. A little bit about us. We are a CRGO steel core manufacturer based in Noida. We have 2 units based in Noida and Greater Noida with a total installed capacity of about 18,000 metric tons. Our products include cut laminations, slit coils, and assembled cores, and we are approved by PGCL up to 400 kV class. We can move further. So we have 3 manufacturing facilities now. Like I said, Unit 1 and Unit 2 are completely operational with a total capacity of 18,000 metric tons. We have recently conceived Unit 3, which we are hopeful of starting in May, with a smaller capacity of about 1,200 metric tons. Our products, like I said, include cut laminations, slit coils, and assembled cores. Slit coils are produced by the first process, which is slitting. Then we produce cut laminations by the process of cutting on automatic CNC lines. It is designed as per the customer's requirements and needs. Every order is tailor-made. And then the final step is assembly, which results in assembled cores, which is a labor-intensive process. Our customer presence includes these many cities within India. Like it is visible, we have a pan-India presence. We also have presence in the export market based in US, Saudi Arabia, Oman, Nepal, Bangladesh, and Ethiopia. Some of our customers include big names like Skipper, Maiden T&D, Silchar, Exide, Bharat Heavy Electricals, Crompton Greaves, Shidisai Electricals, and Indotech. All these customers are primarily supplying to end users like Adani Power, Tata Power, then state utilities like KPTCL, PSPCL, and central utility like Power Grid. So we'll just go through the performance highlights of the last half year. As you might all remember, we were in the process of expansion in Unit 2, which led to a capacity increase in October of 24, which we utilized from October to March, and we were able to generate bigger volumes in totality within the second half year. The total capacity reached 18,060 metric tons, out of which total production was about 12,400 metric tons, which was an increase of 32% year on year compared to financial year 24. Like I said, volumes increased 32% year on year. Revenue has increased by 21% year on year. Gross margins have increased from compared to FY24. However, H2 saw a decrease in gross margins considerably. That was primarily because of raw material price fluctuations that led to decrease correction of pricing in the market, which was also passed on to customers through the selling price, which led to decrease in gross margins. Similarly, EBITDA margins were affected because of that, as well as some expenses related to the future growth. Debt to equity has improved mainly because of the increased equity base. We did a brownfield expansion of Unit 2, which was timely completed in October 2024. We ramped up the facility for utilization, and we achieved a utilization of about 75% overall. We also got PGCIL approval in March for the new facility, which we were eyeing to complete within the financial year. We also got another approval from REPDCL that was also based on some of the customers that supply to this end user. Additionally, we started Unit 3, which was operational in 4 months in terms of trials, and we are expecting to start commercial operations very soon. Yeah, I think we can stick to this slide. Our product mix remains pretty much steady, with cut laminations comprising of about 80%, assembled cores to the tune of 16%. We have tried to reduce slit coils and other smaller items so that there is more of value addition in our business. Pan India sales are also pretty much stable, similar to previous years. What we are actively looking at now is FY26. FY25 has been a year of a lot of achievements as well as some setbacks with respect to margins. However, going forward, we have the full capacity available to us going in FY26. Our monthly run rate has already been achieved compared to the targets that we are planning for FY26. We are planning FY26 and FY27 volume growth of another 30%, similar to FY25. Additionally, we are eyeing some more approvals, which include NTPC, Torrent Power, and going up another step in PGCIL up to 765 kV class. Up to 400 kV class, we already have some orders. We have already received orders from for supply of core of transformers going to PGCIL that will be to the tune of 17 crores, and another 15 crores orders are under negotiation. In terms of Unit 3, we have come up with a small capacity. Further, we are also expanding in Unit 2 by some optimization, and our total installed capacity will go up to 23,340 metric tons within FY26. We have also set up a CRGO testing lab at Unit 2, which is important for us as far as power transformer or PGCIL related customers are concerned. We will be reducing our dependency on third-party testing and with the way of NABL accreditation by the end of H1 FY26. This will help us reducing reliance on third-party labs and reducing the lead times that was going for the order cycle, sales cycle. Another new initiative that we're taking is in Unit 3, that is to move up the value chain by producing core coil assemblies and some transformers, special transformers for our export customers. So we have been recently getting inquiries from export customers for core coil assemblies and transformers that we will be producing or starting in Unit 3. Thank you, everyone. I'm open to questions that you all might have.
All those who wish to ask a question may use the option of raise hand and we'll invite you to ask the question. We'll take the first question from the line of Pritesh Chheda. Pritesh, you can go ahead, please. Pritesh, we are unable to hear you clearly.
Hello, you can hear me?
Yeah, a bit louder.
Hello.
Yeah.
Okay. Am I here? Hello. Can I?
Pritesh, you aren't very clear.
Okay. Sir, my question is about margins.
Yes, sir, please.
Hello.
We can hear you.
Yeah. So, So, can you specifically tell what went into play in the H2 margin, which is even lower than the lower end of your guidance? Whatever was your guidance, the guidance was a fairly larger range which you gave as late as in the month of March. And the margin in H2 is even lower than the lower end of the guidance. So, what went into margin number? Second, now incrementally, now since the company has a fairly large variations in margin. So, what I see is a margin of 5% number before COVID, then a peak of 15%, first half last year or just before the IPO.
Hello.
Yeah, Mudit, you can go ahead and answer the question.
Okay. Oh, I thought the question was still incomplete.
Yeah.
Okay. So, Pritesh ji, first things first, I would like to clarify that in March there was a con call that happened where I had guided on a
Hello.
long. Hello.
Yeah. Yeah. So, did you hear my question?
I heard your first question. Second question was incomplete.
The second question is basically your company margin, if I have to see just before the IPO, is at about 15%. Pre-COVID, the number was about ultimately when you get towards 20,000 tons capacity utilization number, what is the number to utilize? Because 50 itself is a big range, and so maybe if you would want to highlight some thoughts there.
Yeah, so let me first clarify that the margin guidance that I've always given is 12 to 13% on a long-term basis, which we have more or less achieved on a full year basis. So we have seen in the past also such volatility in the raw material prices. However, this time it was a slightly different kind of volatility because it was based on some of the mills not getting licenses. So when these mills did not get licenses in say H1 of FY25, people like us had to buy raw material in advance and we stocked up. So we stocked up raw material and plus we were on a growing spree because we knew that H2 we would have to increase sales, we would have to acquire new customers. So for that we needed raw material. If we did not do that at that time, it was a decision that we had to take. If we did not do that at that time, we would have been stuck with no raw material and no sales, or say limited increase in sales, which is what we did. And that was also visible in the value of the raw material at the end of September, which was to the tune of 90 crores. Now the raw material, that all of that raw material has been consumed, which was higher price. And why it was higher price is because in December, all of a sudden, those mills were again introduced and licenses were given to them. So speculatively, the market became quite chaotic. And some of the customers even postponed their orders, and some customers started requesting for better prices because the raw material prices were lower, and we had inventory which was in the months of October, November, December at a higher price. So it was a trade-off between sales and margins at that particular time because we were increasing sales. Now we have almost consumed all of that raw material. Probably some of it is still going to be consumed in April, May, June. But eventually we will again stabilize. Going forward, if there is volatility, we will see some swings in the margins. But we believe that on a full year basis, we will still be able to achieve the previous guidance of 12 to 13%.
Hello, Pritesh.
Yeah, we'll move to the next participant. We'll take the next question from Raman. Raman, please go ahead.
Hello, can you hear me?
Yes, audible.
Yeah. Sir, I just want to know what was the total sales this for FY25 and what was the realization per kg? That's the first part. And the second part, you said in the previous call on when we met in March that Unit 3 can have an additional capacity of 12,000 MTPA. Unit 3, with respect to Unit 3, I'm talking. So this, are we gonna extend, are we gonna plan add 12,000 MTPA capacity for Unit 3, or are we still in a phase where we will watch out for the demand and then take a call?
So the total sales was 368 crores for the whole year.
No, I meant in terms of volume.
Okay. In terms of volume, it was 12,400 metric tons.
Okay.
Right. And the average realization was it was 296 rupees per kg.
Okay, sir.
And sorry, could you repeat the second question?
So second question is with respect to your Unit 3 capacity. So when we met in March, you said Unit 3 can cater to 12,000 MTPA capacity.
Right.
But you also said you are taking a cautious approach with respect to that. You don't want to, overdo the work and then see कि demand ही नहीं था बोलकर.
Right. So with Unit
I just
3,
want to understand what's the stance, because my concern is mainly because there are two things. The transformer sector companies, like the people which make transformers, they have reported extraordinary numbers and given a good guidance, like a high growth guidance. So from that point of view, there is a demand. I just want to understand whether or not there is an actual demand in play for the transformers.
Right. Let me answer that question in two parts. So Unit 3, first part, Unit 3 expansion that we guided or say confirmed was 2,000 metric tons. And then we said that theoretically it is possible to, add another 10,000 or say 12,000 metric tons. So
Yes.
going up to 25 to 30,000 tons. That is theoretically possible. So in terms of Unit 3, we eventually figured out that, we sort of cut down on the actual capacity that we are going ahead with that Unit 3, where we are going with 1,200 metric tons currently. Second part to this is that we are also looking at demand. And since we are already being able to achieve about 80-85% on a monthly basis, so we are currently at a run rate of about 1,300, 1,350 metric tons. Out of say a capacity of 1,500 tons on a monthly basis. So if we are already achieving that, we are also confident of the demand. Because of which we have already placed orders for the new machinery, which will be placed in Unit 2, which will take us to a capacity of about 23,000 tons. and thereon we might be able to expand. But currently we just have to work up to the next 2 years, taking up our quantities to at a growth rate of 30%. So for example, from 12,400 we will be eyeing about 16,000 tons, and the year thereon we will be eyeing 20,000 tons. So for 2 years we are set with these capacities. Now the second part is with respect to the unit 3 additional space that we have, where we are not utilizing CRGO capacity. There we will be manufacturing core coil assemblies and transformers. Transformers mainly for export customers, because we have already been getting inquiries and we are already in the process of signing an NDA with a customer abroad. So we are confident of that kind of business coming in from there. So with that, once we start white labeling for transformers for export customers, we have more opportunities to tap into new customers.
So basically, you are saying ki Unit 3, you will utilize the majority of the portion to forward integrate and manufacture core coil assembly and transformers, right?
Correct. Absolutely right.
So, can we expect any orders with respect to manufacturing of transformers in this year, or is it like a 2 years plan or a long-term plan?
So the customer that we are talking to has given us a commitment of about 15-20 crores on an annual basis. So
Okay.
we are expecting, say, on a conservative basis, we are expecting orders of at least 3-4 crores in this financial year, because the machineries have already, I mean, they're already being ordered, and we are hoping to set it up within the next 2-3 months.
Okay, sir.
So we will essentially get not more than 7-8 months of production from there, and plus we will have to work up our way with respect to other customers to create a goodwill, create a brand in the market as far as transformers are concerned. So it will take some time.
Thank you, Raman.
Okay, thank you, sir.
Yeah, thank you. May I request the participants to restrict their questions to two per participants? We'll move on to the next participant, Shane De Silva.
Yeah, am I audible?
Yes, please.
Yeah, thank you for taking my question. So, Mudit, I had first a normal bookkeeping question. So, I've seen that there has been a drastic increase in the fixed assets this year. So, did we have some older assets which were replaced, or like what exactly has happened there? I would like to know about that. And secondly, on the other expenses, I wanted to know what the other expenses consist of.
Right. So fixed assets, we have put in a total capex of about 19-20 crores, which is the major part of the difference that you see in the books.
Okay.
Right. And the second question is other expenses. So other expenses would include all kinds of administrative expenses, all kinds of consumables, all kinds of expenses not related to employees.
Okay, fine. Yeah, now my second question was on the capacity utilization. So, while you were planning for the Unit 2 expansion, the capacity util in Unit 1 and 2 were, almost optimum levels. Now, the Unit 2 capacity having come in October, I think it's been around 6 months since then. And still, if I see for Unit 2 on a blended basis, the capacity util seems to be around 60%. So I wanted to understand, like, why has the ramp up in this not taken place, and what will be the timeline for this to reach around 80 or 75% util?
So I think okay. So you're talking about H2, right?
Yeah.
Yeah. So H2 initially October, November, December, we faced some teething issues. Orders we had to look out for new orders which were in the 400 kV segment. All those kind of orders are not easy to come initially, because you don't have that kind of experience. But we still did our best, and we executed 400 kV orders to the tune of about 15-20 crores. In January, February, March, we were able to expand, and we had a run rate of about 1,300 metric tons on a monthly basis of the total capacity. See, unit 1 and unit 2 are fungible capacities. So essentially, I have to look at it from the total utilization perspective. So out of 1500 tons, we are already at a level of 1300 tons.
Okay, understood. And one final question. So in your presentation, you mentioned that we've added around 12 new clients in FY25. So can you like share details on who these clients are or what sizes of, orders or anything that we've received from them?
So we have so the number is 12% of the total sales came from new clients.
Sorry, yeah.
Yeah. So essentially, we added new clients like Bharat Heavy Electricals Bhopal. So I'll just give you a small example. Till September last year, where we were present in mostly up to 220 kV class, we were doing business with Bharat Heavy Electricals Jhansi unit. But Bharat Heavy Electricals Bhopal does 400 and above. So after the new capacity was installed, we participated in tenders because we were not allowed before that to participate in the tenders. We participated in the tenders and we got orders from them. So that was a big chunk. Was a big chunk, and then there were a couple of export customers also that got added. Then there was another company by the name of ECE. ECE has two units. One is in Sonipat, where we are already working. Then one is in Hyderabad. The Hyderabad unit was got added in H2. Besides that, there would be all small customers, mostly in distribution segment.
Okay. And one
Thank you.
final
Thank you,
question.
Shane. May I request you to join the queue, please?
Okay, sure.
We'll take the next question from Surya. Surya, please go ahead.
Hi, am I audible?
Yes, please.
Yeah. Hi, Mudit. I just wanted to know that in your previous calls, you mentioned that you're actively targeting to sell higher grade products and higher KV products to increase your margin. So when can we see the conversion or reflection of the same in your margins?
So, like I said, we have already started non-PGCL orders in the last quarter, last half year. Going forward, we already have orders of PGCL worth 17 crores and another 15 crores are lined up. After that, we will be searching for new customers. We are already in discussion with new customers. Some of the customers have already planned their internal audit of the plant, the facility, which is planned in May. Once those are through, we might be able to get business from there as well. So we are hopeful of we will definitely start executing from those kind of orders starting May. But it is hard to pinpoint on the volume or the percentage of volume that might come from there.
Understood. The second question I have is regarding your forward integration plan, how you are going towards transformer manufacturing. Even many companies, transformer manufacturing companies are thinking of backward integration, like Trill has already acquired a company, CRGO lamination company. So what do you think is, what do you say, separating them to eat up your margins, or if your clients also end up doing some kind of backward integration, what kind of moat or advantage you would have over there?
Are you asking this question with respect to transformers or CRGO?
CRGO, I mean, backward integration done by some of the transformer manufacturers. If they also start doing in-house CRGO lamination,
Right.
what kind of advantage you would be having over there?
So we have seen in the past that a lot of transformer manufacturers have tried or successfully done backward integration. For example, BHEL is already backward integrated, but still it buys a large chunk of cut laminations from the outside market. Then some of the players who did backward integrated, they discontinued the CRGO manufacturing operation because they were not able to deal with the inventory, the timelines, and the inflexibility of selecting different grades based on their designs. Then the third aspect comes where power transformer manufacturers have to in a power transformer, if say the core required is say of 100 tons, then there will be additional scrap or say WIP generated to the tune of 25 to 30 tons. That cannot be used in a power transformer. That has to be used in distribution transformers. And we have a variety of customers where we are able to churn that inventory quickly, which is where we sort of got on a back foot in the last half year also. Our WIP had actually substantially increased because we focused on power so much that all of that WIP, that additional 25-30% of WIP started piling up. And we did not have enough distribution customers. So it's a matter of optimization that we want to do, and that is where our skill lies. So once that optimization is complete, I think then we will be able to, very gladly and healthily say that we have achieved the required growth.
Got it. Got it. Thank you so much.
Thank you. Thank you. I think Mr. Pritesh Sheda's line is clear now. Mr. Pritesh Sheda, please go ahead with your question.
Yeah, hi. So, Mudit, I got your answer that incrementally you're saying about 12 to 13% operating margin, right? That answer I got. Is that correct?
Right.
Okay. Now my question was, I still did not understand why were you at the lower end of the guidance in H2, when you are saying that you had high-priced inventory, which was getting cleared, that you should have known in the month of March, right?
Correct.
So then why were you lower? Then is it a situation where you did not communicate it properly?
No, I definitely communicated that in the month of March, where I said that 10 to 15% would be the guidance, and there is raw material fluctuation present in the market.
Was there any mark-to-market inventory on CRGO that you are carrying in the H2 number?
I'm not sure I understand that question.
So whatever inventory that you bought, did you consume the whole inventory during the half year?
No, so which is what I said. There is some inventory left over from January also, which will be consumed within April and May.
So whatever raw material you had, did you have to have a markdown on that raw material numbers in the P&L, or there was no markdown of that raw material number?
That was taken on cost basis.
Cost basis. Okay. And what was the fluctuation in the CRGO price? Because what we understand, the fluctuation in CRGO price was in the first half. There was hardly any fluctuation in the second half.
So my average purchase price in say starting of the year was about 190 to 200 rupees per kg.
Okay. Okay.
And it went up to about 255 rupees.
Okay.
Say in October, November.
Okay.
And eventually it started going down, and today it is at around 230 to 35 rupees. So there has been a big fluctuation.
Okay. And my last question is, now you are calling out a margin number of 12 to 13%. So that's the midway between 10 and 15%, lower than what you were pre-IPO, just a year before the IPO. I have one question. We see still going backward integrated on its 75,000 MV of capacity, making their own laminations. All the industry players in laminations have doubled their capacity. Whether it's you who's tripled, Vilas Transco is doubling, or there is Mangal, which is basically tripling. Are we entering a phase where margins actually go back to pre-COVID numbers, which were like 5-7% EBITDA margin in a very short span?
I think pre-COVID numbers were low, or say margins were low, primarily because of the supply chain rigidity in supply chain of the entire transformer industry. We believe, I mean, at least I can say from my own experience of say 12-13 years, that we've seen different cycles, but the margins have not affected those cycles. The cycles have not affected those margins as much as the customer demand has affected it. So the customer demand was not there. So everybody was fighting in that particular zone.
Yeah, so it's a classic oversupply situation,
Right,
which was right.
it was an oversupply.
Oversupply before COVID. We are actually, aren't we heading to an oversupply situation in the industry?
Thank you, Pritesh.
Yes, to answer.
Yes.
I'll just answer this question. So,
Okay.
I mean, your guess is as good as mine. We can be going into an oversupply situation. I cannot say that for sure. On the risk of not being misquoted, I would just like to say that we are going on a stable basis. We want to continue that path, and we would eventually try to reduce the debt, because we know that if there is a cyclicality in the business, in that sense where the supply is greater than demand, the only thing that protects us is being stable and cautious in our approach. We have seen those cycles, and we will continue to do that.
Okay. Thank you very much. All the best.
Thank you.
Thank you. We'll take the next question from Prolin Nandu. Please go ahead.
Yeah, hi. Vinay, thank you for giving me the opportunity. Mudit, am I audible?
Yes, absolutely.
Yeah, Mudit. So, two questions from my end, right? The first is, as Pritesh also highlighted, right, that all the laminates player, whomsoever you also had called out in the last call, right, are expanding their capacity, right? And when I do my math, Mudit, top 6 players account for close to 60 to 65% of the capacity, right? Plus there is a capacity expansion, or most of these players are doing, right? So when we think about our own capacity expansion, is there a story where obviously we want to participate incrementally or with a higher share in the transformer growth, right, or the core industry growth? But is there also a story of some of these transformer players wanting to deal more and more with organized players like us, or some of the top 6 players, right, or some of the 2-3 players that you called out in the last analyst meet? And can you help us understand if this trend towards moving towards, let's say, top 6 players is very, very strong? What could be the yield differential from a transformer point of view for buying a CRGO laminate from a player like JB versus an unorganized player? Can you just give some understanding about, to give us some comfort that with everybody expanding capacity, the risk that probably Pritesh has highlighted will probably may pan out or may not pan out? Just can you give us some understanding about this, Mudit?
Sure. At least from my experience, we've seen that the industry has always been in a mostly unorganized state, and it has to be looked at through different segments. So distribution power specifically, distribution segment will continue to have n number of CRGO manufacturers. The business is such that it is very easy to enter and put up a capacity and start procuring raw material and start supplying to transformer manufacturers. The key lies in consistency of supply and quality. So basically, the customers who require consistent quality and are short of time, basically the ones who are working at in volumes, we try to approach those customers, at least as far as distribution is concerned. With respect to power transformers, again, that segment, the number of players are little. They are lesser than the distribution segment. They are about 6-7 players, and that will continue to be there. It is not like the 6-7 players are going to go away. They might reduce or go up. As long as one of us is going bust, nobody knows when that will happen or to whom it will happen. But if that happens, only then the others can get a better market share.
Understood. So you are saying that in power transformer, that movement, I mean, there would always be limited set of 6-7 players, right?
Correct.
To conclude,
Absolutely.
right? And that's where it's a more quality conscious kind of a market, right? In some sense, is
Yes.
that understanding correct?
Yes. So basically, there are some requirements with respect to the plant, and so for example, I just gave you the example of the lab. Now the PGCL approval that we got is contingent on a condition that we have to get NABL accreditation for the lab in the next 6 months. which is why we have a deadline of September to get NABL accreditation, which is required for PGCL 400 kV class certification to be kept in order. It's not like they will, strip us off the certification. But then those things are the key facts that many of the other manufacturers or the ones who are in distribution would not like to go through.
Understood, Mudit. That's clear. The second question is on your comment again in the past call that you want to move towards higher KVA, right? Now, part of it is to get that PGCL approval, which if I'm not wrong, you have got it for Unit 3, right? Now, how long and what was, I mean, you mentioned the lab requirement, right, as one of the requirement to get that approval. What are some of the other requirements which are there to get the PGCL approval? How long did it take you to get that PGCL approval? And once you get the PGCL approval, how long will it take for customers to start taking our product, testing our product, accepting our product, right? In some sense. So this journey of moving forward from a lower KVA towards higher KVA, what all things you need to keep in mind, to successfully make this journey?
Right. So we were approved in 220 kV class in Unit 1, and now we got it for Unit 2. That is the story. For 400 kV class, right? So Unit 1 is only up to 220, and Unit 2 is 220 as well as 400 kV. That is one thing. Now, we started this journey back in 2016. It took us almost 1.5 years to get ready for the kind of requirements that PGCL wanted us. Those are mainly based on infrastructural requirements as well as the history of supplies to our customers. So it took us almost 1.5 years to get the first approval. Then since 2017, when we got the approval for Unit 1, we have been consistently supplying to customers for PGCL orders. That created a history or say a reputation in PGCL that JB Laminations can supply PGCL approved material to transformer manufacturers. The only thing that was limiting us in Unit 1 was space and the machine infrastructure. So when we did a brownfield of Unit 2, we designed it in such a way that we had to get PGCL approval and move up to 400 kV class. So the timeline of that was what, 6, 7, 8 months of installing the new facility. And once that facility was installed, we got active with PGCL. We approached them that, look, we have supplied 400 kV jobs in non-PGCL orders to certain customers, and we got the testimonials from the customers and all the documentation that was required with respect to the company, with respect to the infrastructure facility, that was submitted to PGCL. And PGCL then puts an inspector in charge for the audit. They audit the plant and put some further contingencies or conditions. Once we are able to fulfill that, we get the approval. Our aim to get that approval was January, February, but it eventually turned out in March. So it took us, I think, 3 or 4 months to get PGCL approval because
So
it had a history.
I understand. Just one follow-up question. Why are you
Roland-
not targeting the
Roland,
760 kVA? Just let him answer that, and that's
I'll
it.
just answer
Thank you,
this.
Mudit.
Yeah. So 765 kV, again, the requirement of machinery, infrastructure, and everything else is still the same. There is no change at all. The only thing different is the, again, history of supply. So once we are able to commit the history, the supply of these PGCL orders in 400 kV class, then we will be able to apply for 765, and then that will not be a very big challenge for us.
Thanks, Mudit.
Thank you.
Thank you.
We'll take the next question from Paras Chheda. Please go ahead.
Yeah, thank you, sir. Just wanted to understand, sir, if we have already now started supplying 400 kV and at some point we'll have this 765 kV also, how much incremental margin can these produce over our traditional EBITDA margins that we are currently looking at, 12% odd? Because your 12 to 14%, does that also factor in the extra margin that these higher kV classes can produce?
Yes, that the blended margin includes 400 kV class orders. let me first tell you that the 765 kV class definitely opens doors for us, but there is more demand in 400 kV class compared to 765. 765 orders are very limited in the market, so 400 kV class was the main aim that we got. Secondly, the margins are generally, I would say in terms of percentage, it would be about 2 to 3% higher on a general basis. But there could be, difference in supply and demand gaps with respect to certain grades. For example, a certain grade is not available, and that particular grade has to be approved by PGCL also. If somebody does not have that grade, we are able to command a premium. So based on that, the margins can go up to even 3-4%.
Okay. Right. And sir, just also wanted to understand how confident are you of achieving this 30% volume? And I see this inventory and receivables have also gone up sharply. So could you explain that?
So like I said, on a monthly run rate, we are already at 1300 tons. So if you see 1300 multiplied by 12, we are already at 15,600 tons monthly run rate.
Okay.
Just a little more push, we will be past 1350, which is probably the average that if we need to achieve in order to get to that 30% target. Sorry, what was the second question?
I mean, the inventories and trade receivables have sharply increased.
So inventory has actually come off. In September, like I said, we were carrying an inventory of 3 to 4 months to the tune of 90 crores, and it has reduced to 76 crores, and we are further in the process of reducing it. See, we were in an uncharted territory with the new expansion and the new segments that we were targeting. We did not have the idea of or say the projection of which grades would be required in what quantities. We buy all grades, but there is a certain projection that we do based on past experience, past ordering cycles that the customers have. But for the new customers or the new segments, we were a little in the uncharted territory, so we had to sort of stock up. And plus, moreover, there was a little bit of chaos in the raw material market also. So we actually stocked up, and now we are reducing it, and now we are going towards that optimum level of 60-65 days. And if you look at it from both inventories and receivables from a perspective of monthly or say a quarterly sale basis, we are pretty much in the 60-70 days range. So for example, in the Q4, our total sale was about 113 crores. So 78 crores was the receivables.
Right.
Yeah, so that translates to about 70 days.
Okay, so the inventories will get optimized, this year is what you are saying.
Correct.
Right.
Inventories will get optimized, receivables will not reduce, primarily because that is the kind of cycle that we have to,
Yeah, because the volumes will also go up now, so that
volumes will
way,
yes.
absolute basis will not reduce.
And one more thing I want to point out here is that receivables are some of the receivables to the tune of about 30 crores are protected by the use of a letter of credit. So we use an LC discounting facility where those receivables are already protected, and the other receivables we are protecting through the process of credit insurance.
Right. And like someone, sir, asked you, and I just wanted to, re-ask that the fixed assets has disproportionately gone up. Now, what was the, primary factor for that? The 5 crores going up to 24 crores.
Yeah, so unit 2 we expanded, and we did a total capex of about 17 crores in the plant, machinery and building. And in unit 3 we did a capex of about 3 crores.
Okay, understood.
So essentially all of that was for the new expansion that we did in unit 2 and unit 3.
Right. Given that the inventories are pending, raw material inventories to be consumed in April, May, you're still confident of a 12-14% margin for the next year, I mean FY26?
On a yearly basis, yes.
Right.
And previously also I've guided on a long-term basis, which is mostly yearly basis. if you see our EBITDA margins, it has been constantly increasing. On a half year basis, you might see a decrease. But we knew that if we are able to do a 15% margin, so we had some scope of taking those risks where we could experiment and go for higher sales, aggressive sales, which is why we were able to get PGCL approval in the first place. If we did not go for those aggressive sales where the margins were lower, or say the pricing set by us was attractive to the customers, not attractive to the customers, we would have not gotten PGCL approval within the targeted timeline of March.
Right.
Right.
Okay.
Thank you. Thank you, Paras. May I request you to rejoin the queue, please? We'll take the next question from Kayan Irani. Please go ahead.
Hi, Mudit. Mudit, can you hear me?
Yeah, loud.
Okay, great. So, Mudit, going from FY26 up to FY27, FY28, now that we are on this expansion phase and other industry players are also expanding, can you just guide if we can reach the capacity of around 30,000 by FY27, FY28? And if we do, what would be like the base case utilization levels and the risks to, not meet that utilization level?
Well, since day one, we have always maintained that we will go for capacity expansion in a phased manner. We will not go for a sudden chunk of expansion. What we want to do is we want to expand, say about 50% or 40% addition of capacity, then probably hold on for a few months, optimize that, and then go for another round of expansion. Had we not been confident of achieving the run rate that we are at, we would have not gone for buying new machines that is going to take us to say 23,000 tons. But once that is through and we are confidently able to view or say have that vision that FY27 we are achieving 20,000 tons, it is very difficult to say that we will go for a further capacity expansion as of now, which is why because that risk of oversupply and demand, a difference in demand, definitely stays there. Nobody knows that even that kind of a risk is also valid for transformer manufacturers, for all that we know, because transformer manufacturers are also expanding capacities. Some of them are doing 3x 4x capacities, so eventually transformer industries might also see that kind of a slump. But what we want to do is we want to focus or diversify into export customers. Now we are exploring those kind of customers, that what is the exact demand and where we can fit in with those customers, where we can add value to those customers. We already started off by adding value to those customers with assembled cores. The second step is core coil assemblies, where the customers are already placing inquiries with us, but we don't have that facility as of yet. The third is transformers. Like I said, we already are in discussion with a customer abroad for a certain fixed stable business of transformers. Those are small transformers, completely different from the segment that we supply cores in, but the core still goes in that. So we are confident of making those transformers. And maybe if we have a portfolio of these kind of products, we'll be able to sail through any risks and problems that we might face in the future.
Okay, fair. So, but the baseline would be like around 30,000 metric tons by FY27 with a 80% because you're maintaining like a 80% utilization rate if all goes well in the market.
I mean, once we start core coil assemblies and transformers in Unit 3, we won't have the space to do 30,000 tons. We won't have the space to additionally install 7,000 tons. So we would have to look for a completely new greenfield project.
That's all from my side. Thank you.
Thank you, Kayan. I request Mr. Somil Shah. Please go ahead.
Yeah, hi. As we are guiding for a 30% volume growth, so can we assume our revenue growth could be higher than the 30% mark, 35 to 40%?
Somilji, it's very difficult to say because the price, it all depends on the pricing, average selling price. which is why we don't want to give any guidance for the revenue. The thing that is under our control would be more like volumes.
Okay. Okay. So as you said, the prices were higher in the previous quarter. So what are the current prices going on?
So the average price, I think, was around 310 rupees in the last financial year, and currently it is at around average of 295 rupees.
Okay. Okay. And as we are starting this 400 kV class, I mean, as you said, that 17 crore orders. In April we are going to. I think we got orders for 17 crore, and in May also we are expecting 15 crores. So on a yearly basis, what are we targeting for the 400 kV?
On a yearly basis. Okay.
Yes, because that is a higher margin business, right?
Correct. With all the capacities installed, we would ideally want to do about we would ideally want to target about 15 crores of business every month. So
That is 180
about
crores a
180
year
crores.
for FY26.
No, for FY26 we would be targeting about 100 crores, because the new capacity that we are installing in unit 2, that will not be active. So with the current capacity we would be targeting about 9 to 10 crores on a monthly basis.
On a monthly average. Okay. And the EBITDA margin, what we guided for FY26 is 12 to 14%. Did I heard it correctly?
12 to 13%.
12 to 13% for FY26.
Right.
Okay. Okay. That's it from my side. Thank you and all the best.
Thank you, Saumil. We'll take the next question from Kiran. Kiran, please go ahead. We'll move on to Mr. Pranjal Mukhija. Please go ahead.
Hi, am I audible?
Yes, Pranjal.
Hi, Mudit sir. Thank you for giving me this opportunity. So, sir, I have a couple of questions. So currently we derive around 80% of our revenues from cut laminations and 15% from like assembled cores. And I see from our investor deck that we're intending to sort of move much more into assembled cores and forward integrate from laminations. So like I just wanted to understand like what are the margins that we make in assembled cores? That's the first question. Secondly, I wanted to understand given whatever understanding I have of transformers, I think assembled core is one of the most critical elements of a transformer, right? I mean, that is the core. So I wanted to understand, like, why would a transformer company like outsource this main element of manufacturing a transformer to someone else? Like, I wanted to understand. That was my first question, sir.
So cut lamination and assembled cores are pretty much the same thing. The only difference is that it is the next step of process in a transformer core manufacturing process. So cut laminations, once stacked and clamped together, they make the assembled core, right? And sorry about that. So once that assembled core is formed, electrical parameters of that core can be checked that are actually important for a transformer. So transformer manufacturers, what they do, some of them manufacture their core or say assembled core in-house, and some of them actually outsource and say that, okay, you guarantee me everything with respect to the assembled core and then supply the assembled core to me. So it depends on the demand that the customers might have. When I said that assembled cores will command a premium, is because of export market. Because in the export market, the assumption is that they don't have enough labor, and it is a labor-intensive process. And if they don't have enough labor, they would want the cores in the form of assembled cores. Why the transformer manufacturers outsource such a critical process or critical component is because, like I said, many have tried backward integrating, but but CRGO has many grades. The inventory is in a lot of different forms. It has big coils, it has small coils, it has laminations, it has sheets, it has a lot of different things into it with respect to the inventory. So the inventory management and the grades that you have, the grades that you carry in raw material actually matter quite a lot. which is where some of the transformer manufacturers would ideally say, I don't want this headache. You take this headache and you manufacture this for me. And which is why when we go to the power segment, the criticality increases so much that the customer has stickiness for certain suppliers of CRG codes.
Okay, so and the second question I wanted to understand, given that we're forward integrating and we're also like looking to manufacture some special type of transformers. So just wanted to understand like what kind of transformers are these, and like generally like you said you have you have some sort of intake from a customer, like some inquiries there, and like from where is this from, sir? Which country?
I would not be at the liberty of disclosing that right now. Probably give me a couple of months to get this in order. The kind of transformers that these are small transformers, again distribution transformers, but with a slightly different application. They go into household application, industrial applications, but not installed in the fields. So they might have applications in specific industries.
And then this is margin accretive for us?
Absolutely, yes. It is at a better margin, but the volumes might not be scalable to the nth degree.
Sure, sir. Thank you. That was my question, sir.
Thank you, Pranjal. We'll take the next question from Dipanshu Suman. Please go ahead.
So I wanted to understand the pricing over here. So you mentioned that the current price for your end product is about 295 per kg, average for the last year was 310. And in the same way for your raw material, you mentioned that the prices were 200, went to 250, back to 235. So are we losing on say per kg basis over here compared to say whatever price movement has happened? Are we taking some hit of say 10 to 15 rupees per kg?
Yes, correct. That would be correct. And which is what happened in Jan, Feb, March.
So sir, then how like over the long term, if you say like with the capacity also expanding and all these guys and the forward guys and they are doing so much of volume growth, why are we not able to pass on the entire pricing, sir?
Because the movement or say the volatility in the raw material prices came all of a sudden, and our bookings were already in place with the suppliers. Some of them were import bookings which had material coming in pipeline, and some of it was already contracted with the suppliers. So we could not go back to the suppliers and say we want to cancel this order and negotiate on a new price, which is why the pricing was not, we were not able to pass it on. We generally are able to pass on the pricing if the volatility in the pricing or say movements of up and down are to the tune of more than 2 to 3 months, or say even more than 3 months actually, because we are carrying inventory of at least 2 months, right? And in this particular case we were carrying inventory of 3 to 4 months, which is what actually hit us back.
But sir, then why are we not pricing right now in a better way? Because see, as this prices has come down from 250 to maybe 235, we have also decreased our prices. We could have held on to our prices for a few of the months.
Yes. So what happens in that particular case is that every supplier in the market.
So what I'm trying to understand is that is the industry working in a way that they are ready to use on to some amount of margin, but want to be on the volume side?
No, it's mostly because everybody wants to get rid of the higher cost inventory.
Understood.
Right, because we don't know if the prices will go up again, right? Nobody knows that. There is volatility in the market. If the prices go down, it's anybody's guess that the prices will go back or not. So any good manufacturer or say a person who wants to do regular business with their clients would not miss out on the opportunity of losing a client. So if I say let's say if I stick onto my margin and say this is my price, I will not budge down on it. And if I'm not able to sustain that with my existing customers, then I lose on the customer, and then the customer acquisition cost also comes in.
Understood, sir. Understood. Second point, what I wanted to understand is that your monthly capacity is about 1500 tons per month. You are at 1300 tons per month. Right now, you are doing about 1300 tons per month. So why are we not aiming for, say, like abhi, the year has just started, it's just April. So why are we not thinking that we would be able to do 1500? And if the capacity comes as in FY26 and the capacity is coming, can't we exceed the 1500 ton per month target?
So we'll be sitting at about 1900 tons capacity, probably by October, November, right?
Yes.
Till that time, we are still stuck at 1500.
So in this 1500, can you manufacture only 85 to 90%, or you can go to entire 1500?
I mean, we can go up to 94, 95%, depending on the size. There can be a lot of variation. So ideally, the capacity utilization is between 80 to 90%. When we go above 90%, that is in and sort of like an exceptional situation. So for example, if I have a certain machine, but I have a bigger size order, a bigger transformer rating order, that would bode down well for my capacity utilization. But if I have the same machine and a smaller transformer core order comes, then the capacity utilization goes down automatically, even though I have the same tonnage of orders.
Understood, sir. Third point, what I wanted to understand is that
Dipanshu, may I request you to rejoin the queue, please? There are a lot of participants waiting. Thank you. We'll take the next question from Suruchi Parmar. Please go ahead.
Yeah, hi, Mudit. Am I audible?
Yes.
Yeah, hi. Just wanted to have your addressable market increase after you have got this of 400 kV class.
Sorry, we lost your voice.
Suruchi, can you repeat your question?
Yeah, I just wanted to know about the addressable market increase after you got the GCI approval of 400 kV class.
So again, it's a guess, but I think it would be to the tune of round about 70 to 80,000 tons.
Okay, yeah. And this the volume growth of 32%. I know you have already answered this question, but just wanted to know about your view that the sales have increased just by 21%. So is there pressure on realization, and will it further continue after considering all the competition you see?
Yeah, so realizations were down in H1. If you look at our H1 presentation, the volumes had actually increased, but the total sale was still the same compared to H2 of FY24 or say H1 of 24. In H2, the prices increased and the average realization increased back to the FY24 levels. But then on a year basis, on a complete year basis, the average price sort of declined a bit.
So this will further continue considering the competition you see?
I really can't comment on that. There is still volatility in the market. Like I said, that the mills that we were talking about, their licenses expire very soon, and we still don't know whether they will be renewed by BIS or not. So we are still in a position where we don't know whether these mills will come back or they will vanish away. So based on that, realizations might go up or go down. However, with respect to our own margins, we will try to protect them by a better management of inventory. Now that we know what kind of orders are expected in the higher segments.
Okay. Just last one. What is the EBITDA per ton was in half year was 41,000. So can you tell me the number for H2 EBITDA per ton?
I think it was around 30,000.
Okay. Thank you so much.
Thank you. We'll take the next question from Srusti Goyal. Please go ahead.
Hello, hi, am I audible?
Yes.
Yes.
Okay, so I have couple of questions. So as you have mentioned that we are still not sure whether the BIS license will be renewed. So do we expect any increase in inventory, or are we planning to stock up the inventory in case the BIS license does not get renewed?
So we have sufficient inventory as of now for the next 3 months. We already have bookings and pipeline is freezed. After that, we will again have to rely on the existing suppliers who are, say, not under the purview of getting or expiring BIS licenses. So we have good relations with them. Last year also, we were able to secure good quantities from the existing suppliers. So I think supply should not be a challenge. The only thing is when to buy, when to procure, and in what pricing level to procure.
Okay, so my next question will be relating to our transformer segment that we are planning to venture out. I just wanted to know that with our transformer sector coming, do we plan to increase our inventory days, and do we plan to stock up more CRGO for internal consumption?
Won't be required because the CRGO segment will still be a bigger segment, at least for the next 1 to 2 years. It will still be a much bigger segment compared to transformers.
So how much transformer manufacturing revenue are we expecting in coming years?
For this year, we are not expecting much. Depends on when we start, and probably we will get not more than 6-7 months of production, and depends on the availability of orders. By next year, we will definitely try to move up and aim for a number of at least 40-50 crores.
Okay, and as you have said that in it's a follow-up question to the previous question asked that in H2 the prices recovered as compared to H1. So why was the price movement in H1 as compared to H2? Because I guess in H1 we saw the BIS license non-renewables and the raw material pricing shooting up.
Correct.
So the pricing pressure was not on the H1 but on the H2.
Yeah, so H2, what happened was when the prices had increased and we purchased a lot of raw material because we needed to get our expansion plans secured with orders and supply. By December, these licenses were renewed, and suddenly we had a pressure of selling. So then it starts. So for example, December was somewhere around 320 rupees, and then eventually it started coming off to say a level of 280, 290, 295.
This is the raw material pricing.
No, this is the selling price. And with respect to raw material, it was say about 250 rupees, which has now come down to 230, 235.
So you are saying the selling price come down from 320 to 219.
290, 290.
290. Okay, done. Thank you so much.
Thanks, Srusti. We'll take the next question from Yashvardhan Singh. Please go ahead.
Hello.
Yes, please.
Yeah, am I audible?
Yes.
So, sir, given the cyclicity of CRGO prices, what are the margin band that you are looking internally for FY26 at a consolidated level? I mean H1 and H2 for the whole year.
On an EBITDA level, we will be able to achieve 12 to 13%. That is the target.
Okay, and sir, given that we also had con call in March, so that time also we gave a very bigger range for the margins that was 10 to 14%. So do you think that this should this should have been avoided and given the conservative guidance going forward, because this is how for us, like who are minority shareholders of the company, this is like very sad to see margins going all over the place and people expecting 14-15% margins. And then next day, suddenly there is so much bad words about the company, like margin has collapsed and all these things. So just a feedback for going forward. And another question which I want to ask is, how do you see long-term arrangements with your suppliers right now? Is it a fixed price contract or how do you source the material, and what was the inventory levels that we have consumed as of now from H1? I believe you guided 90 crores was our H1 inventory, and how much we have consumed and how much is currently left, and given the monthly volumes that you are in, I think 1300 is what we are right now from April. So how much will be consumed this H1? Because that might again impact the H1 EBITDA margins.
Yeah, so we have inventory which is high priced, which will be probably finished by April, May, and probably just the beginning of June. That is the kind of inventory, old inventory that we have, which was say on the basis of timeline of December, Jan, Feb. The suppliers that we have, we already have all suppliers working with us, or say we working with the suppliers. Our ordering with the suppliers are either on a 3-monthly basis or on a monthly basis, depending on the supplier's interest. Mostly they're on a 1 to 3 months basis. Then we are also buying on spot basis. So whatever we buy on spot basis, that kind of offsets the inventory gain or inventory loss. So we try to keep a certain proportion of buying on a spot basis. That is how we move. Having said that, for power transformers, it is very difficult to buy on spot basis and expecting orders to come. We need to plan ahead, which is why we had more bookings in the last half year. I hope that clarifies that part.
Yes, understood, sir. And
so coming back to your first question.
Yes.
So again, let me reiterate very clearly, very clearly, that I was misquoted in the March con call. I had clearly mentioned in that call that there is raw material price fluctuations, and that could lead to reducing EBITDA margins compared to H1. When I was asked what will be the range of EBITDA margins that we can expect, I mentioned 10 to 15%, considering what we achieved in H1 and considering what we could achieve in H2. And we were at the bottom end of that range. So I believe I never misguided anyone. Going forward, in that call and as well as in my previous calls, I have always guided a guidance of 12 to 13%, which we achieved on a full year basis. On a full year basis, we were able to achieve that again on the lower end of that range. It was close to around 11.5 or 11.6%, but we were able to achieve that. Going forward also, we are targeting that. Let me be clear again, we are targeting that. But if the volatility continues, there could be ups and downs.
Okay, so the recent policy, which has is that beneficial for you guys, the import duty on CRGO steel, and if we are going to anyways consume the inventory that we have from H1, which is the higher November December inventory. So if we are consuming it till May Jan, so the margins for H1 will still be the lower end of the margin profiles that we are working on, right?
Again, I would not like to comment on that because again, I don't want to get misquoted on that.
Okay.
Your second question, there is no, are you talking about the safeguard duty?
Yes.
So there is no safeguard duty on CRGO steel.
Okay. Thank you, sir, and all the best for the future.
Thank you, Yash. We'll take the last question from Vidisha. Please go ahead.
Hello, sir. I wanted to understand, is there any effect of the ongoing US-China trade war on our business? And also, do we see any effect of dumping ahead? So, will we be able to continue the demand for the products that we have?
Are you talking about dumping with respect to the US-China trade war, right?
Yes.
Right. So, CRGO steel from China already does not go to the US, because in the US there is a 30% duty before all of the tariffs.
Hello.
30% on CRGO steel coming to China.
Sorry, Mudit, we lost you for a second.
Am I audible now?
Yeah, you are audible.
Sorry. Yeah, I'll just explain again. So, with respect to the US-China situation, there is already a custom duty of 30% on Chinese CRGO coming into the US market, or any steel for the matter of fact. So, Chinese steel was already not existing in the US market. Going forward, with respect to customers buying from India, I don't believe, at least for our product, we don't believe that there will be a difference, because we have a couple of customers in the US, and we are still exporting to the US. Although those are small quantities, but we are still continuing to export, and the customers still have clarity that it might not affect them too much.
Okay, sir. And with respect to a question already asked, so do we see any demand slowdown? Because as said, because there might be a situation of oversupply ahead. So do we expect a continued demand ahead?
Demand seems to be strong at the moment. We don't see any issues with the demand part, which is why we are quite confident of achieving the quantity target.
All right, sir. Thank you so much.
Thank you, Vedi. That was the last question of this conference. I now hand over to Mr. Vinay.
Yeah, thank you. Mudit, would you like to give any closing comment before we end the call?
Yeah, thank you everyone. Thank you for coming up for this call and taking out time. Back to you, Vinay.
Thank you. That brings us to the end of today's conference call. You may all disconnect now. Thank you to all the participants and management for joining on the call.